All right, in this section, we'll talk about international portfolio investment. So, really, the the main driver of international portfolio investment is an opportunity for diversification. So, if you think about, uh, an institution that has equity holdings, maybe a pension fund or the a, a corporate treasury department, or even a wealthy individual. They've got, if they're an American entity that is invested entirely in American equity, well, then if something negative happens to the United States, that's going to affect their entire portfolio. So for example, so when U.S. and China got into a trade war not too long ago, that negatively affected both countries. And so an investor who's entirely invested in American equities would feel that very strongly, where an investor that is invested broadly and internationally would still experience that as a negative shock, but it would be attenuated by the American holdings being a smaller part of their overall portfolio. And so so risk overall decreases when you have diversification in that way. So this chart here represents international investment in equities over time. And you can see in 1980, there was very little foreign equity holdings in dollars. It was a very small percentage of the overall portfolio, right? Something like 2%. But the percentage has gained steadily over time up through 2010, right? So in 2010, that foreign equity holdings on average had increased to 25%, and you can see the dollar numbers rapidly declining. Now, when you have dollar numbers rapidly declining, but the percentage is staying flat, that's just indicative of the stock market just going up broadly, right? So if international stocks go up, but American stocks also go up, you'll see increasing dollars invested in foreign equities, but the same percentage overall. But still, so even though we've settled kind of long-term on something like a 25% ratio, that's quite a bit more than would have been true in the 80s or 90s. So the idea of diversification, as I've described it, is that when one country's equities moves, the other countries don't necessarily move in the same way. They might move in the same direction, but not as much, or they might move in an opposite direction. And so what this is really asking about or thinking about is the correlation structure within the different countries, right? So, in correlation in the statistical sense, where it's how much does the movement of one tell you about the movement of the other? If it tells you everything, it has a correlation of 1 or -1. If it tells you nothing, it has a correlation of 0. And of course, reality will be in between those two things. But you might be surprised at how low these correlations actually are. So this is an example. These are historical returns. So this is up through 1982, right? So this is older data. That's the original paper. But you can see many of these, right? A correlation between Australia and Japan equity markets, 15.15, right? Very small. So and then right. So we've got the Netherlands and Australia, very small, right? So these are all really pretty small, except for right. So the average. So along the diagonal is different, right? So this table is the average pairwise correlation of individual stocks within each country in the diagonal, right? So stocks within the country have a correlation, of 60%, 70%, right? Where stocks across countries can be 15, 14, right? U.S. with the Netherlands is 14%, right? So these correlations are much, much smaller, which means you get much more diversification benefit. And the amount is a lot. So this is what we're talking about is systematic or non-diversifiable risk, meaning that when you have a whole bunch of equities that are all doing their own different things in different countries, the only thing that's going to be common to all of them are globe-spanning events, right? So if you have, for example, an Asian currency crisis, that's going to affect, Southeast Asia very heavily, but it'll affect the whole planet, right? So these a war, right? So when war happens in the Ukraine, then that's a global event that has big effects. But unless a local event is big enough and bad enough to have global effects, it will be isolated. And so that means for investors, the things that make their portfolio move up and down, in the main, right? You really feel movement when your whole portfolio goes in one direction, right? And so those are systematic risks. And the other ones are diversifiable risks, and they don't necessarily go away, but they get much, much smaller when they're held in a diversified portfolio, right? If things are really, really terrible in Luxembourg, I may not even notice in my broadly internationally diversified portfolio. So, and you can see this produces a dramatic decrease in portfolio risk. So this is standard deviations. If you think about a normal distribution, if you have an individual share, you can have very high annual standard deviations. But as you add shares, those risks decline, right? So within the United States, if we invest only in the United States, we can get the risk down to 27%. That's an annual standard deviation. But international investment, we can get it down to 12%. And it actually gets down to 12% quite a bit faster, too, than the U.S. If you look, U.S. doesn't really flatten out until about 45 stocks, maybe. Whereas international, we're pretty flat at 30. So you can get more diversification, right? You'll get more diversification per stock, and you max out sooner, so you don't need to hold as many stocks to get really excellent diversification internationally. And that's even more true if you're a domestic investor in a smaller country. Right? So within Switzerland, you can have, for example, much higher risk investing all Swiss, and then internationally you get that same 12 that everybody else gets. So, again, this is cutting risk in half, cutting risk by 75%. So there really is a ton of benefit to international equity investing. And this is really in contrast to, I think, the story you might hear. If you think about it, what's riskier, investing in, American equities or investing in international equities? Well, if you buy one American stock or one international stock and you put all your money in it, well, definitely the U.S. stock is going to be safer, but that is not what we're going to do, right? So if we have a diversified portfolio of American equities versus a diversified portfolio of American and international equities, the overall portfolio risk will be much, much lower investing internationally. So it's actually risky to invest only in the United States, which can matter a lot, because if you probably have at least some idea of what your 401k or 401(b), if you have one of those, is invested in. Chances are that you probably have at least a 50% chance that your personal 401k portfolios are all American equity if you're from the United States. I know when I was looking at my options through work, most of the portfolios were U.S. only, and I really had to go out of my way to get international equity into my retirement portfolio. So the default thing may not be the smart thing in this case. So this is just an update, and you can see these correlations have increased since that study was done in the 80s. And that makes a lot of sense, right? We're in a much more internationally integrated economy now, global economy. So you don't get as much diversification benefit as you used to, but it's still, right, nevertheless quite high. And so we can look at it in terms of Sharpe ratio, and some of the Sharpe ratios for a solo investment in Canada or Germany is pretty low relative to, a broad international portfolio. And Sharpe ratio in this case is, let's see if so Sharpe ratio is the return, the excess return you get for doing a risky equity investment relative to a safe asset, and then divided by the standard deviation of that risky asset. So you want the standard deviation to be low and the returns to be high, and that's what an international diversified portfolio does really well. Is the returns, so average returns to an American portfolio are actually slightly higher, but with so much more risk, it doesn't end up being worth it. And there's a theoretical reason why the Sharpe ratio is probably a decent approximation to a kind of investment practice that maximizes utility over time. It's not perfect, and it probably doesn't. I mean, to truly maximize it, you need to know a lot of factors, but in terms of a rule of thumb on average thing, there's a good theoretical reason for the Sharpe ratio to be a decent measure of that. And it does really well. So, one thing to note about these correlations is that correlations aren't the same up and down. So you might be nice and diversified on the way up and very correlated on the way down. And that's not good, right? We don't want to be correlated on the way down, right? That way you're only getting diversification when it doesn't help you, right? So you'd want to have, you could have a big win if you were correlated on the way up and then diversified on the way down, but you get the opposite effect. So that's a problem. But with discipline, it's fine. So here's the average return correlation over time. You can see correlation has increased since the mid-90s. So these are in those 12 major international stock markets, but still a good value to diversification. So, selecting an optimal international portfolio is a balance of risk and return. So beta measures the amount of systematic risk in a portfolio. And so if we look at a domestic, a local domestic stock market, it's going to have a beta relative to the world's equities, and it might be higher or lower if it's a higher or lower risk area. And so we can measure the overall performance of a portfolio using Sharpe ratio that we talked about before. But think about which kinds of allocations into which countries or how much in each country produces the best Sharpe ratio. Now, the challenge of this, of course, is that returns going forward aren't necessarily the same as returns going backwards. So if you use strictly historical returns, you can come to silly conclusions. For example, just based entirely on historical returns, there is no reason at this point to invest in anything other than Bitcoin, right? If you just believe that the history is the future, then of course you would put all of your money in Bitcoin and you'd mortgage your house and put in Bitcoin, and and you would stop eating and put it in Bitcoin. But that's of course not realistic. There's very good reasons to think that actually the future won't be the same. So so that's again the caveat here. But when we're talking about a brand new asset like Bitcoin, that's a lot different a proposition than thinking about something like a stock market that's. Stocks have been continuously traded since at least the time of Isaac Newton. So we have a long history of kind of what stocks look like relative to other asset classes, except maybe debt. Debt is even longer. So so the optimal portfolio can be found by maximizing the Sharpe ratio, and then so we can look at so if we do the Sharpe ratio maximizing international portfolio, then we can compare it to the purely domestic portfolio and look at the increase in Sharpe performance and the increase in portfolio returns. And so this is how much benefit do I get from international diversification relative to the domestic portfolio, and so there's so you get these are all these different measures. So let's go through this nice and slowly so we can get there. So we've got, this is the column provides the composition of the optimal international portfolio without considering exchange rates. That's over here, LC. And then we've got a risk-free rate, and the risk-free rate. So we want to use a really the lowest risk thing we can think of. So 1 month Treasury bill is like a common use of that. And so what's the so this is what's in, right? This is what we would put in the optimal international portfolio by where you live, right? So if you live in Australia, you'd put a little Australia in, but no one else would, right? So that's interesting, right? But as an American investor, you still invest quite a bit in America, and actually you invest more in America than other places. But, so 60% equity, 30% risk-free rate, and then a smattering of other things. But yeah, 60%, and then the remainder in Hong Kong, the Netherlands, Sweden, and Switzerland. Whereas, within France, it looks different, right? We're more European. So, right, the smart portfolio is different depending on where you are for lots of reasons, but none of these are one number, right? None of these are one number. So, the Sharpe ratio maximizing portfolio does internationally diversify, regardless of where you're currently located. Okay, so when we come back, we'll talk more about composing an optimal international portfolio and equity investment.